The biggest risk to your financial future isn't a stock market crash, it's sitting on the sidelines. You've heard the advice 1,000 times, right? Start early. Let compounding do the heavy lifting. Don't let your money sit idle. And yet, most people are still just watching the game from the bleachers rather than actually getting on the field.
And the crazy thing is, you already know you should be doing this. You hear it from your friends, you see the YouTube explainers pop up in your feed. It's literally everywhere. The knowledge is out there. You get it. There's no escaping the advice.
So why haven't you? What's actually stopping you from pulling the trigger? Let's dive into this explainer because it's clearly not a lack of information holding you back. It's about psychological roadblocks. Something invisible is hitting the brakes right before you make a move.
Quick heads up before we get into the weeds. This explainer is strictly for educational purposes. It's not personalized financial advice. But looking at the mechanics of human behavior, let's explore what's actually happening in your brain when it comes to your money.
Think about this for a second. On paper, investing sounds so incredibly easy. Step 1, put your cash into the market. Step 2, just wait. Step 3, watch it grow. Boom, done. But in real life, it doesn't feel simple at all. The second you sit down and actually open an account, a tidal wave of uncertainty just hits you. The absolute first thing your brain screams is, whoa, what if I lose money? All of a sudden, those dollars you worked so hard to save feel totally vulnerable, and your survival instinct kicks in. All you want to do is protect them. And right on the heels of that comes the next panic. What if I pick the totally wrong thing? I mean, nobody wants to be the person who confidently dumps cash into the one asset that completely tanks, watching their savings evaporate. And then the ultimate nightmare scenario pops up. What if the entire market crashes literally the day after I invest? That fear, it is remarkably powerful. It paralyzes us. We tell ourselves, you know what, I'll start later, when I have a bit more cash or more knowledge, or when things feel a bit more stable. But let's be honest, later keeps moving. Plus, let's add another layer to this, complexity. Look at the sheer volume of options out there. Stocks, ETFs, index funds, bonds. It's a massive wall of financial jargon. There is just so much noise, and human nature dictates that when we don't fully understand something, we naturally back away. Not because we don't care, but simply because we are terrified of making a catastrophic mistake. And here's the real kicker. There is zero urgency. If you don't invest today, absolutely nothing bad happens right now. There's no penalty fee, no warning light flashing on your dashboard. And because there are no immediate consequences, it just never feels like a burning priority. So we end up doing nothing. And doing nothing feels wonderfully safe. Your money is just sitting there in your checking account. No losses, no mistakes. But here is the crucial point. Doing nothing is not a neutral state. It is an active, deliberate financial decision. And it comes with a massive hidden cost. Let's compare these two realities. On one hand, you have zero market losses. Feels great, right? But on the flip side, you have silent inflation. While your cash just sits idle in that safe, inflation is quietly, relentlessly eating away at its buying power year after year. You don't get a bill for it in the mail, you don't see the numbers go down on your screen, but make no mistake, it is happening right now. Let's put some real numbers to this to show you exactly what that delay costs. Imagine two people. One starts investing $500 a month at age 25. The other waits until they're 35. They invest the exact same amount every month into the exact same stuff. But the difference in the final outcome when they retire? We're talking hundreds of thousands of dollars. That staggering, jaw-dropping gap isn't because the 25-year-old worked harder or found some secret stock. The difference isn't effort. It is literally just time. They simply didn't hit snooze on their financial future. So let's bring this all together. You aren't avoiding investing because you're lazy. Avoidance stems entirely from fear, confusion, and delay. It's human psychology at work. But remember, the longer you wait, the harder it becomes to catch up, because that wealth gap just keeps growing larger and larger every single day. If you take one thing away from this explainer, make it this. Action beats perfect knowledge every single time. You do not need to know everything to start investing. You just need to jump in before you feel fully ready, rather than waiting forever for some magical moment of total clarity. This quote perfectly sums up the reality we've been talking about. Waiting feels safe, but it's often the most expensive decision you can make. It completely shatters the illusion that hoarding cash under the mattress is somehow protecting you. So, I want to leave you with this final thought. Now that you see the invisible forces holding you back, and you've seen the literal mathematical price tag attached to them, will you continue paying the silent cost of waiting?